Rupee has been continuously depreciating vis-a-vis your dollar. Last year, everybody said that now somewhere rupee will stable, but that's not happening. What are your views on that?
I think we had a very stable currency for 7 8 years. So some kind of sudden disruption in geopolitical made a large depreciation immediately. But if you see a 5 7 year trend, we are that same 2.5 3% kind of currency depreciation. So which was not happening for 2 3 years suddenly happened. I think that 2 or 3% depreciation Indian currency will continue to happen.
Is this a good time for NRIs to consider investing in India?
It has always been a ready-made platform. NRIs will always have a large chunk of allocation towards India or the country they reside. So mostly it's US and India.
How do you select stocks for both PMS and AI? Hello, my dear investors. My name is Vikas Agarwal. I am the founder of Altiport. Alt is your alternates, and Port is your portfolio management services. Some of you might be familiar with the fact that we keep organizing these knowledge-based sessions, and we call it Ask the Expert Show. So, welcome to the brand new show of Ask the Expert. And with me, I have someone very special. His name is Praveen Ladia. So, thank you so much for taking the time out, Praveen, and accepting our request. So, Praveen brings about more than 2 decades of rich experience when it comes to capital markets. He all his life he worked with asset management companies. In fact, he was abroad and then came back to India, worked with one of the largest asset management companies of India, which is Motilal Oswal. Spent about almost 7.5, 8 years. And then recently he has taken over as CEO at Karma Capital. Well, Karma is one of the institutional players when it comes to managing institutional money under the PMS platform. So, Praveen, first of all, congratulations.
Thank you so much, Vikas. It's
Yeah.
a great journey we had for 20 years.
Yeah, great. So, Praveen, the other thing I wanted to congratulate you is for that you've just completed your organization 20 years. So, just let me start with that first. So, if you can talk to us about Karma Capital first, how has been the journey, and then I'll come to your journey.
So the promoters and the founders, they are two co-founders of Karma Capital, Nikhil Desai and Rushabh Seth. They were colleagues before they set this up, and in 2005 they came together to set up Karma Capital with one vision of creating institutional platform. They have always been an FI institutional investors forever. So their first mandate was from Switzerland, and over the period of last 20 years, we have managed money for various pension funds, endowment funds, global investors, and even now a large portion of our money what we manage is from global investors. So that brings a lot of comfort that the institutional process is already been there for last 20 years. And last 2 or 3 years, we have come out and offered our offerings to domestic investors. So a journey with many market cycles, but that has fine-tuned our processes, that has fine-tuned the way we think. And as we always say, not all cycles are same. So the next cycle will be very different from the previous 20 years as well.
Right, right. So, can you talk to us about these last 20 years that you spent? So, all that money that you manage is it the PMS platform, or you also have your own AIFs?
So from day one, we have had the PMS platform with the evolvement of AIFs and gift cities, etc. Over last 2 years, we have set up an AIF Cat 3 as well for us for our domestic investors, and now we have merged it all together at a gift city platform, which we have just made live.
Okay, okay.
So that marks our journey towards gift city for our inbound investment for global investors.
So that's inbound, like
Yes.
inward. It doesn't invest
So
outside.
we take global money there, investing into Indian equities, and also this year we have registered ourselves under US regulations, so we can openly go and market to US institutions as well.
Okay. So I have a lot of questions on behalf of my investors in this area, particularly Kip City, but I'll come to that later. So let me first talk to you about what's your house views on the markets, because last 15 to 18 months has been a roller coaster ride for Indian markets, and Indian markets broadly kind of underperformed, especially in 2025, as I talked to you in 2026 January. So maybe we can start with that, because there are a lot of investors who have requested us to ask this question on their behalf.
No, as because you rightly mentioned, Indian markets have underperformed drastically, both developed markets as well as emerging markets last year. We are already seeing corrections in terms of time correction because the earnings are now catching up with the valuations. The large caps have done well in 2025, whereas small and mid caps have done reasonably underperformed, and small cap particularly. What as a house we see that we became very careful in 2024 September. And if you've seen last 3 months, we have started talking about our Lotus portfolio, which focuses on small and mid cap. So we have seen that the risk diversification is much better, favorable in terms of small and mid cap now. Secondly, the world has talked about AI and tech. It is there to stay. So
True.
the companies which will adopt it well for their benefits are the ones which are going to win. It is not the same. Over last 7-8 months, we have identified new areas of businesses, something like a med tech. There is we are heavy on healthcare, but it's across segments. Something like payments, we have been talking positively about last 1 year, which was not the words. So we believe that our style of investing, where we try to identify early cycle, is going to help. There are pockets. The benchmarks or the broad based indexes doesn't look very, I would say, in terms of corrected. But if you see stocks, there are stocks which are 40-50% down. What was working very, very well last year is not working well now, and we think it will not work. So 2026, especially the first 6 months, this thing is the time for consolidation. Identify the pockets where you think next cycle of money would be made. On a risk reward basis, I think it's very comfortable to start allocating. Obviously, there will be pockets of volatility, given there's global uncertainty around because of various other reasons.
Yeah.
And it keeps changing, you can't predict.
True.
So keep consolidating. There are reasonably good mid and small cap companies with decent liquidity to participate with. So we are allocating, keeping the next cycle in mind.
Okay, okay. The other thing that I want to pick your mind, Praveen, is that rupee has been continuously depreciating vis-a-vis your dollar. Last year, everybody said that now somewhere rupee will stable, but that's not happening. So what are your views on that?
I think we had a very stable currency for 7-8 years. So some kind of sudden disruption in geopolitical made a large depreciation immediately. But if you see a 5-7 year trend, we are that same 2.5-3% kind of currency depreciation. So which was not happening for 2-3 years suddenly happened. I think that 2 or 3% depreciation Indian currency will continue to happen. It just
Historically, 3-4%.
that's the one. If you see a 5 year trend, we are at that. 23-24, we had a very stable currency, and just because of the new US administration, there were certain concerns on currency, so suddenly India got impacted. But if you see it has corrected back to a normalized level now, the knee-jerk reaction is gone away.
The other thing is, to serve the institutional, especially if they are foreigners, Karma Capital has been always very, I would say, very strong in terms of understanding the human psychology of these investors. So, how to read your mind and understand when you are talking to them, what do they think about India now?
See, India, for global investors, India is one of the emerging markets. So they always compare you with other emerging markets. Last for 5 years, India had a great run. If you see last year, people started comparing us to China, and China started becoming. So there are concerns on valuation as we speak now. Like we had some calls yesterday, today, and we keep talking to investors across the globe. There are reallocations, and that's why you see a lot of money moving out of India,
True.
especially 18 billion this year itself.
Yeah.
And that's why still the domestic flows are taking care of the downside. But there are rearrangements happening. People are bound to invest back in their own markets. The rally in the US will not continue like that. So we feel that that kind of money will come back to emerging markets, and more especially in India. If I see growth, I think everyone is wanting to hear what's going to work well. There is a lot of questions on the new age companies getting listed, which we always tell investors don't get carried away by narratives, because narratives is not what the fundamentals talk about. So you have to look through the fundamentals to find whether the narrative is right or wrong. So the discussion is around valuations. The discussion is around the right time to enter back, and the discussion is about the new age companies coming into the listed market space, or the IPOs recently happening. So that is where the investors are trying to reallocate their money. I personally believe the way we have got queries in last 1 month or continue to happen in June, January, I think there is a good demand that the people will come back to India very soon.
Okay. The other thing is, so at Karma Capital, you manage pension fund there. You take the mandate. How does it work? These foreigners, because if you look at their FIIs holding in India, it is at 10 decadal low, in the sense that the overall exposure in Indian equities have come down to about sub 16, 15.5%, whereas the domestic, what you rightly said, is going inching up 16.5%. So what? How do you take the mandate? What kind of investors that you serve? If you can talk to us and share with our
So
investors.
as you said, over the period of 20 years, we have worked with fund of funds, we have worked with pension funds, we have worked with endowment funds and sovereign wealth funds as well. The mandate for us has always been all cap. Just because we manage institution money, we are a little concerned about liquidity in place. Most institutions have a 3 to 5 year kind of a view, or maybe more and more. So you can take contrarian bets in their portfolio. You can always identify stocks much earlier and wait for it to go, as a compared to retail or HNI investors. So when we look, we always had an all cap mandate, and we always had allocations across large, mid, and small. It's not what people talk about that FIs only come in large cap. I think the mandates we have managed so far has always had a flexibility of fast going.
I see.
Obviously, we don't go below 2,000 crore market cap given that we have a large chunk of money and we need to take care of liquidity and risk. But beyond that, we have not seen any FIs or any foreign investors coming and telling us that you only manage large cap for us. And with Indian ETFs and passives evolving, I think most FPIs now take large cap through ETFs. So for us, the mandate has always been all cap, and our strategy has always been all cap. Allocation across, the flexibility of move between large and mid and small happens, but we have not seen any restrictive mandate. A couple of global funds also give us mandate to manage ESG compliant. That's the experience we also have. We take seg mandates to manage ESG compliant portfolios as well. But that's the only consideration they have given us in addition to being flexible to anything we do.
Correct. Now, my question is, in the last 20 years, what kind of tenure they commit, in the sense that are they really worried about exiting from Indian markets, or they come with 5-10 years of view? How is it?
So, the large chunk of money what we manage today, the investor has been with us for 13 years.
Oh, wow.
And it has kept topping up, topping up, topping up. So we started with say $100 million, and today we are close to $500 million for them. So it's a 13-year period, and we don't have any window of knowing that they're going to exit. So generally, the global investors come for 5+ years view, as I said, and it keeps adding as Indian markets have shown growth, and this is the only pocket of growth we see globally. They keep coming back and keep allocating back. As I said, the investors compare emerging markets. So in that, what is the great pocket? Even from an emerging market index, you have certain allocation. They do certain overweight to ensure that the growth gives them the extra alpha, and that's where India stands out. So I don't see any investor other than this particular last 6 months. I have not seen large investors going out of India. And even in this large outflow, I think there are 1 or 2 large investors who tried to exit out of India or taken a large portion out. But most of them has just rebalanced 10-15% of their India allocation, not more than that.
Okay, okay. Now, I want to now discuss about NRI's investment. So, what are you witnessing as a house that is this a good time for NRIs to consider investing in India?
See, being an NRI earlier, I can relate very well what you're saying. See, what I always call is for NRIs, the pockets are very limited in their minds. Not that globally they are limited, but we always have a home bias. And when your home is doing so well, why go somewhere else, right?
Right.
If I have a home bias saying that I have a comfort knowing Indian companies, knowing Indian promoters, what India is doing, I will always come back. Unless India is not doing well as a country, as economy, as markets, they will go somewhere else. So I think it has always been a ready-made platform. NRIs will always have a large chunk of allocation towards India or the country they reside. So mostly it's US and India is the large allocation between two countries most NRIs
And
have.
Gulf to some extent.
Local markets limited, but primarily other asset classes within Gulf or
Sure.
Singapore or Hong Kong, wherever the investors are. But the home bias always pull them back to India, despite your currency depreciation.
Right.
And touchwood, India has been doing very well for last 12 years in particular.
Yeah.
So we think they should always keep coming back to India. There's no reason not to. And with new changes in geopolitical issues, I think most of brain drain will come back to India. So that rupee will help them when they come back to India.
Right.
So as I said, asset allocation wise, both US markets, some part of Gulf markets, as you said, some equity as well as real estate there. And Indian markets, all valuations are high. So that rebalancing has to happen, and home bias, as I always say.
Right.
You always come back home for comfort.
Correct, correct. Now, I want to also discuss that I keep getting this question from my set of NRIs investors that they want to discuss about the instruments now. So you have AIFs, PMS, and then mutual funds. What do you think? What makes sense for them at this point of time, knowing the fact that there was a time when you have to route the money through Mauritius, etc., but then you have now Gift City in place.
So Gift City is another offshore platform wherein you is a route where you invest through a platform to India. NRIs have access across. Certain local taxation laws, especially in US and UK, define what instrument you use. May not be so true for a Singapore or a Gulf-based NRI. But if you are a US or a UK-based NRI, The taxation laws in your local country or US tax or UK tax laws tells you that you should ideally, in the best tax efficient manner, should invest into a PMS platform.
Okay.
Because there are tax laws where you pay tax on mark to market, on notional gains as well in your local country,
Right.
despite not booking profits. So mutual funds for them becomes tax inefficient per se, for especially for a US based NRI. So you also should consider tax as a component. Mutual fund, as you said, is a very mass retail product where everyone participates. If I keep the tax aspect around, it is always there, that's there for everyone. But if you want alpha, if you want a 2025 stock, if you want concentration, a style biased as we call, certain managers have a different style which suits PMS and AIF platforms, then they should look at PMS and AIF. That's true for any investor. But if they just want to do plain vanilla, they can always use this PMS. But I think for tax purposes, most NRI should look at PMS as a platform.
Yeah, no, the other thing I wanted to tell you is that I was looking at the data the other day, and there are 350 AIFs under the gift platform which got registered, and they are subscribing new investors. They are taking inflow, and what we are witnessing at Allport is that there are investors, NRIs, and they are really exploding this big time. So, do you also see the same trend?
Yes, sure. That's why we have activated a Gift City platform last year with government focus and on the other side the acceptability of gift as an offshore jurisdiction. So it takes time for everyone to build comfort on a jurisdiction. It takes time. There are global places which have comfort of many years.
True.
So gift is where, if you see last 18 months, it has transformed drastically. Because it took 3-4 years for the regulators, for the investors to understand it thoroughly. They also made changes to the regulations for international standards. So the acceptability is very high. Once the acceptability of investors and global investors come, then the asset management companies go and launch their products from there. So that's how we just ended up, our Mauritius platform merged everything on Gift. So we think Gift will explode as one of the leading platforms for India investments for sure. And what I'm seeing for last 12 months specifically, a lot of Gift City funds are taking resident money to invest outside India under the LRS route, etc. So that is also becoming very prevalent, that the Indian investors are also getting comfortable taking a fund which is investing in global asset classes and through Gift, because that's for mentally it's a domestic platform.
Right, right.
And the regulations are very similar to what Indian regulations are in terms of the fund structuring.
Now, to share this with all our investors. So, in Gift City, broadly, there are two ways of investing: inward and outward. When I say inward, in the sense that you take money from NRIs and invest in Indian markets, and outward essentially gives you permission to invest across the globe. And by the way, I looked at the number. 95% of the funds which are listed is to invest in India, and it used to be very difficult. And Karma Capital would kind of agree to this, that it was very difficult to have set up in Mauritius, route the money. If you are an US based investor, route the money to Mauritius and then bring to India. So at least that hassle is gone away for you as a
Yeah,
manufacturer.
so time zone benefits. As you said, you are in Gift, so your time zone benefits in terms of investment, in terms of coordinating with markets is there. And as I said, the acceptability is becoming far more. The most easy way for Indian asset managers to set up an inbound, what you said, investing into Indian markets and
Yeah.
taking global money. And with domestic investors also accepting that, the other way will also get prevalent over time.
Yeah.
It's not happened very actively now, but I think over the next 2 years we'll also see a lot of outbound. As we have seen in mutual funds, there are a lot of international funds which evolved over the last 6-7 years. So Gift will also become like that. But frankly, it's always have a comfort. If I'm an Indian entity, I have a lot of comfort in setting up something within the Indian
True.
geography, I
Right.
would say. Although the regulations are offshoring, but the geography is India.
Correct.
So I think most asset managers or most banks in India have now set up a Gift City platform. The reason being, one, the government is focused to make it a global hub. So there
Yeah.
are a lot of incentives to do it.
Correct.
Second, a lot of large institutions have now started investing in a gift platform. So that gives a lot of credibility to the jurisdiction. See, once investors start coming, it's not about only number of funds, it's number of AUM, number of investors coming in. The once large investors start setting up their platforms or invest to those funds, the credibility becomes very large. I think Gift is at the cusp of that. It will explode big time over next 2 years.
You think so?
I think so. I think the way it has happened, and you have been propagating it for last 2-3 years.
Yeah. No, so what we are witnessing is that in fact there are some private credit funds in CAT too, And for any US investors to get about 10, 11, 12% kind of yield is just a dream over there. And what we are witnessing is, as I said, that these investors are curious to explore various options in category 1, 2, and 3. I want to come back and talk to you about taxation aspect now. So, how does this taxation work in Cat 3 or AIF?
So taxation is standard. In domestic, it's paid at the fund level, whether it's gift or domestic. With the government or the saying that taking away the tax benefits or DT has gone away, gifted at par with any other offshore jurisdiction now. So taxation is at par. So for AIFs or for gift, the tax is at the fund level. So the investor what they get is post-tax NAV, which is what they get in hand if they redeem. So,
Right.
so tax obligation is taken out from individuals to the fund level. Obviously, when for NRI specifically, it also depends on the local taxation in that country what they are
Yeah,
liable to.
yeah.
But that is true for any asset class, any platform rather than only AIF. But the Indian tax aspect has been taken care by the platform AIF itself.
So you're essentially saying that the taxation is done at the fund
Fund
level.
level, yes.
So irrespective of which country you belong to, I mean, you'll have to see your local taxes and not really bother about Indian taxes.
Yes,
That's
Indian
it.
taxes are taken care at the fund level, whether it's a domestic AIF or a gift city platform. The Indian tax authorities is not going to come to investors. It's the liability of the fund at the fund level.
And how does it work for mutual funds?
For mutual funds, once
Under the same gift category 3 AIF, there are some AIFs where they are setting up a cat
fund
3
of funds.
and then fund of funds.
So for fund of funds, it's you pay tax when you redeem from the funds, right? As and when you do transaction, you pay capital gain taxes for
Yeah.
the platform. So it's very similar. Instead of stocks, you are just buying funds. So as and when you redeem from a fund, you are tax liable. As we buy a stock and we sell the stock, as soon as you sell a mutual fund from that platform, you pay taxes at the fund level. So the taxation is always at the fund level, depending on debt versus equity. Your
Yeah.
tax liability is decided, but the AIF pays the tax even on a fund of fund structure.
And the other thing is, how does it work? Like you take money in dollar term and you
Yes,
return, and
Gift
then what
City.
about the volatility in rupee?
See, it's point to point. So all offshore platform, including Gift, the money is in foreign currency. You're not allowed to take local currency in INR. So whoever takes money in any currency, you can have multiple currencies there. So we do only US dollars for the time being, but one can have multi other currencies as well.
I see.
So as you take dollars, India, you have to invest only in rupee. So you convert the dollar into rupee, and you invest in Indian markets or stocks in rupees, or in funds, whatever your mandate is. And whenever you're selling, and if somebody wants to redeem, that's the only time you convert rupee back to dollars.
So what happens when the rupee depreciates?
So it's point to point. So in between, the volatility is part of your NAV. So we publish a dollar NAV. So
How frequently? Once in a month?
twice a month.
Okay.
So you get the dollar, we convert rupee as per exchange and tell you what is your dollar value. But the real conversion only happens when somebody is trying to take the money out. So we convert rupee for them in US dollars and pay them US dollars. So your impact end to end is what currency rate you came and what currency rate you are going out. In between, the volatility is part of the valuation. So your rupee NAV and your dollar NAVs are different. The currency impact is already shown.
But is
But
there
there's
a
no
way that you
transaction in
can
between.
hedge?
See, the hedging, people ask for that question, especially for you can do that if you're doing a credit or a fixed duration product. But markets is anyways volatile, and the cost of hedging is at the range of 5 to 7%. So for annual basis. So if you try to hedge even for 1 year and you don't use it, that money is gone. So if you don't have a clarity when you want to take out the money, you cannot hedge it because the
So
cost of
risk
hedging is very,
reward-
very high.
So risk reward ratio is very negligible.
So if you're
I mean, you
looking
want
at
to
a
save-
15, 17% rupee return and you want to pay 5, 7% for hedging annually, it makes no sense for you because the depreciation is as low as 2, 3%.
Yeah.
At the time of taking your money out, if you think it's not favorable, wait for some more time. If there's a knee-jerk reaction. But at the end of the day, if I don't know the duration, there's no point hedging every year paying 5%. If the markets give negative return and you even end up paying 5, 6, 7% for hedging, it's a negative return. It makes sense for a credit strategy because you know your money is going to come in 2 years or 3 years.
Right.
And then you can decide whether you want to hedge and have that extra cost for a certainty of US dollar and INR exchange rate. But for an equity or for a unlisted products, it makes no sense.
Correct, correct. The other thing is that investors are curious to know last decade when you look at dollar term returns of India, what kind of returns they can continue to expect. 10
See,
years
we
down the line?
always say what market has done, we'll do the same. Currently, there's no disruption in India growth story. You still are looking at a 7% kind of growth for the country, which was at 7.5, 8 for last 10 years in terms of real. So if we continue to do that, uh, on a long term, you get 15, 16% rupee returns, 3% depreciation of currency, so 12 odd percent dollar returns. The country has given that for last 10 years, and we don't see reason it will not give for next 10 years. So US dollar denominated between 10, 12, 13% is something reasonably workable even at this valuations and at these levels. But you should have a 3, 4, 5+ years view.
Oh, yes, I am talking about almost a decade or.
So, and as you said, India can always surprise.
Yes,
There are so many smaller businesses which are coming up. There's such a huge plethora of options. You may be surprised on the upside, I think, but I doubt there'll be a downside to that.
correct, correct. So I want to just talk to you about what's your style of investments. How do you select stocks for both PMS and AIF?
So our style has been constant. See, in India, you cannot be away from growth. So we obviously are growth investors, but we follow GARP style of investing, which is growth at
At a
reasonable
reasonable
price.
price.
So you will never find stocks in our portfolio which are very, very expensive. Secondly, we every now and then we try to identify early cycle investing. So that's something which has been constant with us for 20 years. We ideate on an early cycle basis. For example, we had started talking about payments a year back. A year and a half back, we started talking of payments as a business model, which had its own downside previously, but it has turned around, and we think that's going to change with digitization in India. Second is we had a lot of disruption is insurance business, life insurance in particular in 2024. So December 24 onwards, we started talking that insurance is something which is early cycle. It's all the pain points are gone away, so it will get better from here. So we started looking at life insurance to start with. The businesses turned around, and obviously with GST cut, benefit given to insurance company, that has turned a different level which we didn't know. But so we try to identify early cycle. For example, people think you don't make money in large caps. We identified Bharti 5, 6 years back at 500 odd levels. It is 5x story. We used to own airports businesses, so we looked at buying Interglobe Aviation 4 years back. It is almost 3x for us in 4 years. So even in large companies, if you're right in the cycle, you can make a lot of money. And similarly, obviously in small cap, we have multi-baggers anyways. But we think identifying businesses turnaround or identifying little early than the markets or before the narrative starts talking about them is where you make little extra money. And that has been our style forever, that we buy GARP, we buy early cycle and trying to be ahead of the narratives.
Talk to me about your team, investment team. How big is your team, and do you have your own first-hand research, or you're dependent on some institutional research?
So, other than the two co-founders who are co-CIOs, we also have a 6-member team on the research side, and a couple of them has also upgraded now to being part of portfolio management team as well. The good part about us is that obviously 20 years of co-founders, it's been there because there, but out of the 6 members, we have 3 members who are more than 10 years with us. So the consistency of the thought process is continued. So it's not a star manager. We are not looking for coolies only. We are looking for a team effort. As we always give an example that RCB did not win for many years despite having Kohli and AB de Villiers because it's a team game. So at some point in time, it's a star manager or single man philosophy we don't believe in. So the team out of, as I said, out of 8 members, 5 have been together for more than 10 years. And there are 2 more who have been there for 2, 3 years now. So that's the small, we get also freshers to give us new ideas. They understand new businesses. So currently we have 8 members, out of which I think we have 130, 140 years of experience. Obviously, we do use sell side as well, but out of our active coverage, so we currently cover around 350, 360 stocks. Active would be around 200. I think 130, 140 stocks are small capish there. Because in many large caps, you don't need coverage. My sense is around 70, 80 stocks where there will be either no coverage from the sell side or 1 or 2 small coverages from the sell side. So there is still primary research going on from our end.
Right. So being a CEO, whenever participate in investment committee, my question is, uh, has your fund manager ever reported that because you talked about new businesses, the SME, BSE, SME and NSE SME segment has ended up delivering close to 85-90% kind of CAGR in the last 5 years. As an organization, Karma Capital ever thought about picking up some stocks at an early stage of their growth curve from that segment?
See, for you are talking about the price returns. and many of the SME companies have not also made any return. So there's a flip side to it. The reason we have not looked at SMEs, those are very, very small businesses. From our research and for the AUM we manage, currently manage around 7,500 crores. Such small businesses makes no sense in the portfolio. Second is the liquidity aspect. So given that we manage a lot of institution money and we are very conscious of risk, we are conscious of liquidity, we do not look at SME because those are very, very small businesses. Half of the information is not available for you to go deep dive in those businesses. That's why then the SME exchange. So given that transparency is less, given that the information about them is very, very less, and the liquidity is so less that the returns are just driven by buyers or sellers, doesn't give us comfort to go there for managing public money. We have a fiduciary responsibility of managing money and identifying. And when you talk about SME, I can give you some data points. I was talking to one of the investors this weekend itself, and he said, and he made a 35% return on his SME portfolio. And I was aghast, wow. And this I'm talking calendar year 2025. And he suddenly says, I have 60 SMEs, only 11 has worked. 49 has not worked. So only 11 has worked. So it becomes like a startup funding. You take bets on 50 companies, some will work, some will not work. You just hope that something works better than the others.
Okay.
So there is no process in investing in SME as of now. People understand some companies, they invest. We have stayed away from it so far.
No, my sense is that India is now divided in two parts clearly. So these new businesses which are emerging, gone are those days when promoters used to wait for 10, 20 donkey years to get their company listed and raise funds. Now, because they're coming early, of course, what you rightly said, there would be a possibility when they come early, they rush in terms of raising capital. They would have not done enough in terms of demonstrating their capabilities. But perhaps you never know, 5 years down the line, 7 years down the line, as we become more mature, probably you will see more good numbers coming up from there.
You rightly mentioned, let that market be matured. What we have seen is a euphoria for last 2 years. We think let the market be matured, let the investors in that market get matured, and the business is also mature. At any point in time, if we see some business is very good, and we like the model, we understand what they are doing, we'll go and buy it. We are not anti SME completely, but it has to fit in the process. It has to fit into the risk criteria we look for, and if it works for us.
Right. So before we conclude, Praveen, what would be your message to investors if they are looking at investing? They consider large cap, mid cap, small cap, number one? Should they really consider equities because gold has really outperformed last year? And if they yes, then which scheme they should look at as far as Karma Capital is?
No, because I know you know my favorite book. I always quote to you as well. What got you here won't get you there. So please don't look what happened in the past. Please look what you want to achieve
Sure.
going forward as well. So I think there the headline numbers doesn't, as I said, started with say the headline number doesn't make sense to me because there are pockets which are 40-50% down. The darlings of the market last year are down 30-40% even on the like a trend or ITs or banks or whatever. So look at pockets which have corrected 40-50%. There are a lot of businesses which are good businesses, corrected 40-50% just because of narratives, just because people like stories.
True.
I believe stories are for bedtime. For investing, you should look fundamentals.
And numbers.
And numbers, obviously. And then, obviously, the story of the business because you have to trust the management beyond a point. But narratives follow once the fundamentals have gone up. And on the downside, also, it's like that. So don't look for narratives. Don't do it because somebody else has done it. Don't do because your friend has bought an SME stock and made 100% return. Look for pockets where you see downside protection because the volatility will be very high this year as well. Global uncertainties, as we said, keeps going. So look at pockets where your downside protection, margin of safety is very, very important. Look at businesses which are using tech, as I said. There are new age businesses coming, like we always talk about healthcare. And 20 years back, healthcare was always pharma. Right? It was only medicines.
True.
Whether US, and we only know in US and Indian markets or whatever. 5 years back, it started with hospitals and diagnostic as a new chain of businesses coming into. Today, we have medtech. Going forward, we will have medical equipment companies. Going forward, we'll have trading companies. So the healthcare ecosystem itself will develop so big. So don't get stuck by saying healthcare is pharma. Similarly, even in financials, we put out a note few months back saying that investing beyond banks and NBFCs financials. Now you have insurances. You have insurance traders and marketers and distributors.
Your mutual fund company.
Your mutual fund companies. Capital markets again gone beyond. You can look at payments, as I said. There are a lot of payment companies. There are payment gateway companies coming in IPO over next year. So don't get frenzied by the big names. Look for pockets of margin of safety. That's very, very important because not everyone can have a 50% drawdown. So look for pockets of safety. There are a lot of opportunities right now, even in the combination of old and new businesses. Don't think only new businesses make money. I think last 6 to 12 months, I've heard a lot of people talking about new businesses, quick commerce, e-commerce, delivery platforms,
Yeah,
etc.,
yeah.
etc. There are businesses which are there, but fundamentally, even the traditional businesses make a lot of money. Like I said, insurance is something which is we are very bullish on, which makes a lot of money. At some point in time, your consumerism, the face of consumer is changing. The way you look at FMCG is changing now. What was supposed to be a moat 5 years back is no more a moat today. So look at those changes, look at those trend changes, and wherever you think there's comfort of valuation, please put money there. We personally believe there's lots of opportunities between that 2,000 crore to 20,000 crore market cap, small cap, which we call, but it's the higher end of small cap, which has fallen between 25 to 50%. And there's great
Broadly,
businesses
so far.
available which are turning around and making sense.
Okay.
So good time to start slowly allocating
So
to
do
small
you
and mid.
have any mid and small cap
So I
strategy?
said we run various strategies. We run one all cap, which is a 20-year track record, which is the flagship of ours. We seeded a small and mid cap strategies 3 years back. We completed 3 years in February. We started marketing that. There we manage 65-70% at least small cap, and then eventually can go up to 100%. And we also are launching a new strategy going forward where we take special situation bets as well to some extent to add that extra alpha. So those are three buckets we start working on.
Okay, okay. All right. So from
From an investor perspective, our all cap is called Jasmine, and our small and mid cap is called Lotus portfolio.
Lotus, okay.
So that's how we put flower names.
All right, great, great. It was absolutely pleasure speaking with you, Praveen. Thank
No,
you
no,
so much
pleasure
for
is all mine. I hope the investors and you guys had some benefit out of it, and happy to be on your show
absolutely,
anytime.
absolutely, absolutely. So I hope all of you have enjoyed this conversation. In case you have any feedback, please feel free to write in the comment box. And next time when I'm going to meet you, I'll be asking that question to my expert. So thank you so much.